Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
EOS Energy Enterprises, EOSE, is maybe the most contentious name in long-duration energy storage right now. We're looking at a company whose story is really defined by two, completely opposing forces. The U.S. government's faith in their zinc halide battery and the market's really profound ongoing skepticism.
It is. It's a complete intellectual battleground. I mean, this technology is trying to disrupt lithium-ion by focusing on safety and supply chain, but it forces you to ask a fundamental question. Do you trust the very stringent due diligence of the Department of Energy, or do you trust the aggressive, entrenched positioning of the short sellers?
Exactly. So the central question for us today is this. Has the DOE's huge $305.3 million loan guarantee finally closed the door on EOS's existential risks and validated their sales backlog? Or does that stubborn 25% short interest signal that the real unaddressed problem is a catastrophic execution risk? My argument is that the government capital and the move toward factory automation, what they're calling Project Amaze, have fundamentally de-risked EOS and positioned it as a future industrial champion.
And I come at it from a different angle. While I absolutely respect the significance of that federal backing, I maintain that the history of allegations of financial manipulation, combined with the extreme difficulty of industrial scale-up for this specific chemistry, still leaves EOS incredibly vulnerable. That short interest, it isn't ignoring the DOE. It's betting EOS will fail the manufacturing test and basically implode on its way to profitability.
Okay, so let's start with what I see as the ultimate vote of confidence, the closing of that $305.3 million non-dilutive loan from the DOE's Loan Programs Office. Now, this is not a simple grant. The LPO is designed to act like a bank, and it requires incredibly rigorous due diligence. They hired independent engineers, market consultants, and forensic financial auditors to scrutinize every single detail of the business plan. The key takeaway here is that for the DOE to close that loan, they essentially audited every single contract, validating the entire backlog. That's a federal stamp of approval that significantly validates EOS's order book. And beyond that, we are seeing that validation convert into actual operational success. In Q3 of 2025, the company reported record quarterly revenue of $30.5 million. That is a 35-fold increase year over year. It demonstrates the operational ramp is actually bearing fruit. So when you combine this with the strategic investment from Cerberus Capital Management, you have non-dilutive capital secured and smart money on board. The message is pretty clear. The most sophisticated capital players now believe in this business plan.
That's a compelling argument on the financial validation, I'll grant you that. But let's not ignore the entrenched bear case, which just has not budged. The short interest stubbornly sits in that 25 to 27% range of the float. That is an extreme level of market pessimism. And it suggests deep-seated doubts that the government's validation really addressed the core problem. My skepticism centers heavily on the backlog controversy. Iceberg Research, for instance, focused forensically on specific counterparties, specifically bridge-linked commodities, which accounted for something like 62% of the backlog at the time. The allegation that bridge-link's parent company was financially distressed, having defaulted on loans, it means the risk isn't that EOS lied about the contract. The risk is that the underlying value of that contract collapses because the customer goes bust. The DOE loan doesn't prevent a customer from defaulting. And let's not forget the shadow cast by the ongoing class action lawsuit. That suit alleges that executives manipulated financial data, specifically goal-sought financials, to satisfy the very conditions required for that critical DOE loan. Until these claims are definitively dismissed, they remain a significant ethical and regulatory headwind.
I want to address that backlog controversy head-on, because this is exactly where the government's action provides a structural defense. The DOE LPO's diligence process is designed precisely to sniff out the creditworthiness of major customers like BridgeLink. They had to assess whether BridgeLink Commodities had sufficient financial capacity and commitment to honor those massive orders. The closing of that loan in November 2024 implies federal teams reviewed those specific bridge link contracts and deemed the backlog sufficient to underwrite a loan of that magnitude. I find it highly improbable that the United States government would risk nearly $250 million on an order book that was 62% based on insolvent counterparties. The DOE put its money where its due diligence was. The narrative has, I think, moved past the question of whether the contracts are real.
I acknowledge the DOE closing is absolutely a setback for the short sellers focused purely on the, let's call it the fraud narrative. It substantially de-risks the claim that the company is actively lying about its order book. But I just come at it from a different way. The persistent skepticism suggests the market believes EOS will still fail the execution test, regardless of where the backlog came from. The allegations of goal-seeking financials, even if they're unproven in court, suggest a potential historical willingness to, push boundaries or manipulate inputs to satisfy external requirements. This history, combined with the immense challenge of scaling industrial production, makes investors wary. Whether the backlog is real or not, if EOS can't deliver the batteries on time and at the cost needed to be profitable, the whole thesis just collapses anyway.
You've laid out the financial risk perfectly, but we can't really talk execution without discussing the underlying technology. The bears often argue that all this execution hinges on solving the fundamental flaw in their battery, the efficiency. We frequently hear the argument that zinc-based chemistries are fundamentally uncompetitive due to low round-trip efficiency, or RTE.
Well, that's the core technical challenge, right? Historically, zinc-based chemistries have struggled to push RTE much above 70, maybe 75%. And you contrast that with the incumbent, lithium-ion, which consistently boasts RTEs of 90 to 95%. For high-value applications like energy arbitrage, buying power cheap and selling it expensive, the economic penalty of losing 25% of your energy in every single cycle is substantial. It makes the technology structurally uncompetitive for those specific applications, no matter how safe it is.
It's been a historical criticism, sure, but we have to deal with the performance of the latest Z3 generation, which is what they are now manufacturing. That RTE lag is acceptable when you weigh it against the significant structural advantages of the Zen chemistry. First, the system is non-flammable because it uses an aqueous water-based electrolyte. That is crucial for dense urban environments or critical infrastructure, where installing complex fire suppression systems for lithium-ion can completely destroy the project economics. EOS enjoys significantly lower balance of system or BOS costs, which is everything around the battery itself, because they eliminate those expensive safety measures. And second, the supply chain is insulated. It utilizes earth-abundant, domestically sourced zinc. This insulates EOS from the geopolitical risks tied to the Chinese-dominant lithium supply chains. That domestic content advantage is what triggers the powerful Section 45X IRA tax credit, which is a massive lever for future profitability.
But is the efficiency good enough now to offset the higher material and production costs they still have?
Yes, it is. The operational data is improving, and fast. EOS reported in their Q3 2025 release that a Department of Defense site using the new Z3 generation was achieving an average RTE of 84.6%. And while it still trails lithium-ion, that is a massive step up. It brings the technology into a commercially viable range, especially when you couple it with the lower capital expenditure and a claimed cycle life of 5,000 cycles. Designed for 100% depth of discharge. That makes the technical trade-off worthwhile.
The 84.6% is an important data point. I agree it significantly narrows the gap. But let's circle back to that execution test. That technical improvement only matters if they can produce these things cheaply and quickly. The entire path to profitability relies on operational excellence, and specifically Project Amaze.
And that's where the investment thesis truly turns positive. Project Amaze is the industrial pivot. The company is moving away from the manual, negative gross margin processes of the past to fully automated Z3 manufacturing lines. They partnered with Acer Automation specifically to design a production line that reduces unit costs by approximately 50%. This automation is the single most important mechanism for achieving management's guidance of positive gross margins and positive operating cash flow in 2026. If they successfully scale up to their target of 4 gigawatt-hours of capacity, the Section 45X IRA tax credit alone could contribute nearly $180 million annually. That completely alters the profitability profile of the entire company.
I'm just not convinced by that line of reasoning because it relies entirely on a forecast of perfect execution against a history of deep losses. While the gross margin improved sequentially in Q3 2025, it was still deeply negative at, what was it, negative 33.9 million. They are still burning significant cash. Look at the numbers. Management's full-year guidance for 2025 revenue is between $150 and $190 million. Given they only achieved $30.5 million in Q3, that implies an enormous, unprecedented ramp in Q4 2025, likely exceeding $100 million in a single quarter. That isn't a ramp, that's a manufacturing moonshot. It creates a massive execution bottleneck and risk of cash burn if production delays happen. We are talking about the valley of death risk. We saw what happened to ESS Tech. They couldn't execute on manufacturing, issued a going concern warning, and faced a liquidity crisis.
EOSE is attempting to scale faster than anyone in non-lithium storage, and the penalties for delays are just catastrophic.
The comparison to ESS Tech highlights the exact point where EOSE has succeeded in insulating itself. EOSE has already crossed that commercialization threshold and secured the funding necessary to actually fund the scaling. The DOE loan and the Cerberus investment provide the runway that ESS Tech lacked when they hit their crisis point. The challenge is immense, yes, but the infrastructure is now in place. We're simply debating the timing and efficiency of the ramp, not the viability of the company as an ongoing concern.
I disagree that it's merely a debate about timing. The valuation reflects the expectation of a perfect, aggressive ramp.
It's fascinating how this whole debate plays out in real time in the market. The stock is currently oscillating heavily, trading right in that $13 to $15 range. That price tells you everything you need to know about the tug-of-war between institutional validation and market fear. And this tension is, further illuminated by the analyst landscape. You have these high-conviction bullish targets like Stifel and Guggenheim, setting sights in the $20 to $22 range, while more conservative voices like Jefferies and B. Riley maintain targets closer to $6.50 to $12. But the core data point that captures all this complexity is the short interest. It remains stubbornly high at over 25% of the float. That's over 82 million shares sold short.
And that volume is critical because it translates to a days-to-cover ratio of 6 to 8 days. That confirms this isn't just a fundamental debate. It's a massive, coiled spring dynamic. The market is aggressively positioned for steep correction. Any slight positive surprise, like achieving that aggressive Q4 revenue target or a major government contract, would force a massive wave of short covering, creating a severe short squeeze that would drive the price far above its theoretical intrinsic value.
For me, the narrative has successfully shifted from solvency to execution. The capital runway secured by the DOE and Cerberus has solved the liquidity risk. EOSE has successfully transitioned past the commercialization risk where its peers faltered, and it is now poised to capture significant market share because of its unique safety profile and secure domestic supply chain advantages. The focus is no longer on surviving, but on scaling up to become a cornerstone of the American long-duration energy storage infrastructure.
I acknowledge the de-risking of near-term bankruptcy is real, but the core execution risk remains severe and is being priced into that high short interest. The company has to achieve manufacturing perfection and the promised 50% cost reduction through Project Amaze in 2026 to justify its current valuation and the bullish analyst targets. If they fail to deliver that rapid ramp-up, the stock risks a steep correction, as the market currently lacks the faith required to clear that execution bottleneck. The divergence between structural validation and manufacturing skepticism just underscores the complexity inherent in backing transformative industrial technology. The evidence is now in the hands of the scaling team, and the market is waiting to judge the results.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.